Hey traders, welcome back to another episode of SimplySafeFx. In today's video, we're diving deep into a powerful trade entry setup that blends ICT's Unicorn Model with smart money concepts for even higher probability trades. The Unicorn Model occurs when a breaker block aligns with a fresh fair value gap, forming a high confluence trading zone. By integrating smart money principles, such as market structure shifts and order blocks, we can refine entries and maximize trade efficiency. If you're passionate about advanced trading concepts, precise entry techniques, and disciplined trade management, make sure to smash the like button and subscribe for more expert insights. Without further ado, let's get into the video. So, what is the Unicorn Model? It's a trading setup that combines a breaker block with an overlapping fair value gap. Before diving into the details, let's briefly explain these two concepts. Let's further understand these breakers. On the bearish breaker, price making a higher high, failing to sustain that high, and then breaking down below a previous low. The key focus is on the swing low that formed between the two highs. When price returns to this swing low, it can now be considered resistance and used for a bearish trade setup. The same concept applies in reverse for a bullish breaker. This occurs when the market trades lower, takes out an old low, and then breaks above the high that formed the new low. In this case, the focus is on the swing high that formed between the two lows. When price returns to this swing high, it can now be considered support and used for a bullish trade setup. On the chart, a breaker block is a failed order block that transforms into a new supply or demand zone. Now, let's explore how to identify fair value gaps from a candlestick perspective. They typically form within a 3-candle sequence and are noticeable as large candles where the upper and lower wicks of the neighboring candles do not fully overlap the body of the middle candle. This gap, or fair value gap zone, is the space between the wicks that the market tends to revisit. Also, they are considered important price zones where market inefficiencies occur, often acting as areas of supply or demand. When a fair value gap appears on the chart, it indicates an imbalance between buying and selling pressure, typically influenced by institutional activity. This imbalance creates a phase of market inefficiency, where the price is likely to return to the fair value gap area to fill the gap and restore equilibrium. This retracement provides a potential trading opportunity, as price reactions in these zones can lead to continued movement in either direction. Depending on prevailing market conditions, fair value gaps should remain unmitigated to maintain their significance as a high-quality trading zone. We have just covered the basic concepts of fair value gaps and breaker blocks. Now, we can apply this knowledge to understand the ICT Unicorn entry model, which occurs when a previously failed order block transforms into a breaker block and aligns with an unmitigated fair value gaps, creating a high-confluence trading zone. Now, let's apply it into a scalping strategy. Our scalping strategy consists of 3 major steps that must be followed precisely to maximize accuracy and effectiveness. The first step is to analyze the market structure on the 15-minute time frame, identify key price movements, and draw order blocks at significant levels where price reactions are expected. Once the order blocks are identified, traders must patiently wait for the price to reach these critical zones before considering any trade execution. The second step involves switching to the 1-minute time frame and executing an entry using the ICT Unicorn entry model, which leverages the confluence of a breaker block and a bearish fair value gap. This setup increases the likelihood of price rejection, making it a high probability trading opportunity. The final step is to validate all conditions, including market structure alignment and confirmation signals, before placing a trade within the identified 1-minute ICT Unicorn model. Proper risk management is essential in this phase. For long positions, traders should place their stop loss below the most recent low, while for short positions, the stop loss should be set above the most recent high. This approach helps minimize potential losses while allowing room for price fluctuations. In terms of profit targets, the first take profit level is set at a 1-to-2 risk-to-reward ratio. At this point, traders should consider taking partial profits while simultaneously moving the stop loss to break-even, effectively eliminating risk and securing a risk-free trade. The second take profit target is strategically placed at key liquidity zones, specifically the previous buy-side liquidity for long trades and the previous sell-side liquidity for short trades. By following this structured approach, traders can optimize their trade execution, maximize profitability, and maintain effective risk management throughout the trade. Enough of boring theoretical knowledge, let's do some chart analysis. On the euro-dollar, we observe a clear downtrend characterized by a sequence of lower highs and lower lows. As price breaks structure to the downside, it establishes strong structural highs, reinforcing the bearish momentum. As the market moves lower, it creates weak lows, which serve as vulnerable points susceptible to further breakdowns. Once a weak low is breached, a new strong high is formed, further strengthening the trend. Moving on, price makes another break of structure to the downside. It forms weak lows, which act as fragile support levels that are prone to further breakdowns. When one of these weak lows is violated, the market establishes a new strong high, reinforcing the downward trend. If you are unsure how to identify strong structural points, be sure to check out the recommended videos, which will provide a detailed explanation. You can find the links to these resources in the comment section below. Understanding structural points is crucial as they serve as key reference areas where price action reacts. Moving forward, the next step involves identifying high probability order blocks, areas on the chart where price has a tendency to revisit in order to fill liquidity. These zones act as significant levels where institutional activity is likely to influence price movements. On this chart, we can identify two valid order blocks that meet the necessary criteria for a strong trading setup. If you are unfamiliar with how to distinguish high probability order blocks from weaker ones, I strongly encourage you to review the previous instructional videos before proceeding with this section. A solid understanding of order block selection will significantly enhance your ability to execute precise trades. With that said, we have now completed step 1, which lays the foundation for identifying key price action zones. Now, let's move on to step 2, where we will focus on recognizing the ICT Unicorn Model on the 1-minute time frame. This step is crucial for refining trade entries, creating optimal trading opportunities. On the 1-minute time frame, analyzing the peak of a recent impulsive price movement, we can identify the presence of a fair value gap. The candle responsible for creating this gap serves as an order block, establishing a demand zone that has the potential to drive the price upward if it retraces to this level. In most cases, we anticipate a price rejection at this zone, signaling a continuation of the upward trend. However, if the price fails to hold this level and breaks below it without demonstrating support, the order block transitions into a breaker block. In such a scenario, the downward move that breaches the demand zone also forms a fair value gap, highlighting strong bearish pressure. While both the bearish fair value gap and the breaker block are significant trading zones individually, their combination creates a high confluence trading area. These zones are particularly valuable as they align multiple price action signals, increasing their reliability. Due to the high level of trader interest in these areas, they often act as strong decision points in the market, leading to notable price reactions. To enter a trade, a sell limit order can be placed at the start of this high confluence zone, with a stop loss positioned above recent high to safeguard against market fluctuations. Profit targets should be set based on key structural levels ahead, maintaining a risk-to-reward ratio of at least 1 to 3 or 1 to 4. To further enhance trade management, traders can move their stop loss to break-even after securing partial profits once the price reaches a 1 to 2 target. This approach mitigates risk by ensuring that, even if the market reverses and the stop loss is triggered, no capital is lost, while allowing the remaining portion of the trade to run and profit stress-free. That wraps up today's breakdown of the ICT Unicorn Scalping Strategy. Be sure to check out other videos in our Smart Money Scalping series. If you found this video helpful, make sure to like, subscribe, and turn on notifications so you never miss out on our latest trading strategies and insights. Thanks for watching, and I'll see you in the next episode.